Welcome to Pro News Flash. The euro is extending its losses against the US dollar. Let's see what's behind the latest move. The euro has fallen against the US dollar to its lowest level since August 2025 due to diverging monetary policies. The futures market is pricing in a probability of nearly 50% for 2 federal funds rate hikes in 2026 and estimates the chances of 3 rounds of monetary tightening at 15%. Bank of America considers this scenario to be the base case, given the strength of the US economy and the Fed's intention to aggressively combat high inflation. The fall in oil prices due to the de-escalation of geopolitical tensions in the Middle East is depriving the Euro-USD pair of an important advantage. Previously, the rally in Brent crude was seen as the main driver of accelerating consumer prices in the eurozone. This prompted the ECB to raise its deposit rate in June from 2% to 2.25%. However, the collapse in North Sea crude prices this summer suggests that inflation is temporary and will, in all likelihood, force the European Central Bank to take a prolonged pause in its cycle of monetary tightening. Meanwhile, futures markets are increasingly pricing out another ECB rate hike before the end of the year. That's largely because the eurozone economy continues to lose momentum. While June's purchasing managers' indices came in above expectations, the service's PMI remained below the key 50 level for a third consecutive month, signaling ongoing contraction. Since services account for the largest share of the eurozone economy, the weaker data suggests overall business activity is continuing to slow. The fall in the euro-dollar exchange rate is prompting major banks and investment firms to switch to the bear camp. HSBC notes that falling oil prices are no longer supporting the euro. In this scenario, the ECB is most likely to refrain from raising interest rates. Bank of America is taking a tactical short position on the main currency pair. It believes that its future trajectory will depend on the dynamics of US inflation and the actions of the Fed. Overall, the pair's decline suggests investors are paying more attention to interest rate differentials than to geopolitical developments. Much of the easing in Middle East tensions had already been priced in, whereas the Fed's hawkish shift came as a surprise to the market. Stay tuned to Pro News for further updates on developments in the financial markets. Like, share, and subscribe.